Okay, welcome everybody to Volatility Barometer, episode 36, I believe. Hopefully that's right. Let me mute YouTube here for a second before we get started. So thanks everybody for joining today. It's a pretty exciting day. You know, we've been waiting a very long time for this day to come, so kind of feels like Christmas came early this year. It's been several years where we basically just got nothing for Christmas, no new products to play with. But today we've got two new volatility ETPs, and it's an exciting day. Whether you trade them or not, it's still an interesting thing, an interesting development. You know, it was pretty touch and go there. We were kind of wondering whether anything would ever get approved again, given what happened, as we'll obviously get into February 5th, apocalypse, all that stuff. But it has happened. So at least it is now possible that things can get past the regulators and we can start to get into hopefully a more robust volatility space again. Not sure if it'll ever approach the good old days, the glory days of 2017, but we'll see. These new products are exciting and they might help. So very quickly here, we're going to go through the rundown. First of all, actually, I wanted to mention real quick here, just for people who have come back quite often to my live streams. I actually did a system recovery on my laptop recently. I had technical issues with me all the time. Happens all the time. But when I set up everything again, it does appear like my 4K video is somehow turned off. I watched a couple of test videos and looks like old school 720p. So apologies for that. I do have a 4K camera. I've got it set to 4K. I've got everything on my end. It looks good. And then when I watch it back, it's pretty grainy and old school. So hopefully your eyes can adjust to that. And hopefully by next week's episode, we can figure that out. But here's the rundown. We're going to go through what this new SVIX is, what the new UVIX is, of course. A thing that is of interest to a lot of people who like the details of the technical stuff. Why are these any different from the previous products that have been since delisted? XIV, the TVIX, what makes these new ones any different? We're going to talk about the volatility landscape, all the volatility ETPs and where they fit in, what their leverage factors are. And then, of course, the big question, I'm getting a lot of emails about these products, recurring question from very many people, is this just going to cause more problems? And are we setting ourselves up for a 2.0 repeat of February 5th, 2018? So, of course, I will get into that. And then lastly, I'll just give a very brief, opinion on where they fall and whether I personally will trade them. But as always, there's always an open Q&A, so get your questions in now if you want them answered. Don't send me any money. Don't super chat. My live streams are always free. But the entry fee, as always, is you have to hit the like button. So the YouTube algorithm thinks I'm really popular. So go ahead and do that. And if you are asking a question, it does make it a little easier if you say Q or question, stands out a little easier in the chat. So go ahead and do that. I'll just run a little bit of an intro and then we'll dive right into this. Thank you so much for joining me here today. I really do appreciate the support. So my name's Brent Osachoff. I'm a Canadian and I'm a former professional golfer, so you will hear the odd golf analogy slipped in there from time to time. I run, I love movies, diehard UFC fan, and I do love to travel, so you'll see this background change throughout the year. So just give me 1 minute here to do a little bit of housekeeping before we get started. If you do feel like you need a little more structure in your investing, I do also manage a private investing community with members from over 65 countries around the world. And it's all centered around both of our diversified portfolios. You can choose the one that best suits your personal level of risk tolerance. There's a daily email sent out every morning with a ton of very useful volatility metrics at the top, which you can learn more about each one of them and start applying them to your own trading. There's a daily article or video where I break down some of the most requested topics from members. And then most importantly, of course, in every email, every day, I state exactly what position each of my strategies will be in, along with all the allocation sizing and risk management that goes with them. I've made it easy to follow so you can get the same consistent performance the VTS community has enjoyed for over 9 years now. No obligation, but if this is something you may be interested in, go to volatilitytradingstrategies.com, click the subscribe tab, and the monthly subscription does come with a free 2-week trial, so you can check it all out before committing. Thanks again for supporting the YouTube channel and spending a little bit of time with me here today. So let's get on with the show. Okay, so welcome everybody. Thank you very much for joining me. It is 1 in the morning for me. I'm sitting here in Taiwan, so the hours are flipped for us. I would assume it's some normal time for the rest of you. I was just scrolling through the chat. I found this one kind of stood out pretty funny. There's somebody in the chat that's already trying to get me to cancel myself answering questions like that. We'll see. Maybe I'll circle back to that one, but we'll probably answer some more volatility related questions if you don't mind. So let's get started. Now, the first thing that I do want to say, of course, whenever we're talking, let me remove that comment. Whenever we're talking about stuff like this, I do think it's important to mention this boring stuff, but just a little bit of a disclaimer. While I did speak to Stuart on the phone, we talked for a very long time about the products, about where he thinks that they're going to fit into the space, opinions back and forth on whether we need them or not, whether the options are coming, all that stuff that we're going to get into. But I do want to make it extremely clear here that I have no affiliation with any financial instruments of any kind. Don't get paid anything. I call it like I see it. I basically view this as I am responsible to my own community. So you will never hear me giving opinions about any of these products, anybody swaying me in certain directions. I have no affiliations with any of these things. I am just going to give you my honest opinion, and that will be all. So just note that up front. But let's get started with a little bit of a presentation. And as always, this is mostly just for me. It's just bullet points, so I don't forget anything major. But as we go through these, hopefully I can touch on all the subjects. I will try to keep this a little bit light. Obviously, we're going to talk about a few of the nitty-gritty details here, but I promise you I won't get into, the full details of things that'll put you to sleep. I'll try to keep this super basic for everybody. But essentially, what is the SVIX? So the SVIX has launched officially. I did my first video on this volatility ETP. If you go to the website, this is actually kind of funny, and it gives people an idea of the current regulatory environment, I suppose, because if you type in SVIX on the little search bar, you'll see that I actually did a video here. Let's open this thing up, or not. You can see the date on this thing, December 13th, 2019. I introduced the SVIX as a potential product for all of us to trade. And here we are in 2022, March, and this thing has finally launched. So, as Stuart was mentioning, there were obstacles, there were delays, there were, things that were consistently coming up. But congratulations to all of them for finally getting it done. I think it's good news. So here we go. The SVIX is trading. It launched at $15. The UVIX, get used to these tickers. We'll probably use them often. The UVIX launched again at $15, and it's off to the races as well. So I was just checking the early volume. It's not terrible, so I think pretty solid start to the day so far. Of course, it'll ramp up every day, but pretty decent so far. So the SVIX, first of all, we'll talk about that one. The SVIX, a lot of people are calling it the new XIV. Let me just make sure I'm on screen share here. So is it the new XIV? Basically, the reason is because the SVIX is just like the old XIV in the sense that this is a -1 times inverse M1, M2 VIX futures product. So what does that mean? Of course, if you come to my streams often, you know this, but this is the VIX futures term structure. These are all the VIX futures going out, 8, 9, 10 months. And these front 2-month futures are the only ones that we are concerned about here. This is the M1 future, month 1, month 2. Based on how these are moving around, because the products will be holding these 2 VIX futures, based on how these are moving around, that's how the SVIX is going to derive its value. So if it's going up and down, it is a little more complicated than that. Again, you can always go to my YouTube channel. I definitely suggest people do this. Use this little search bar and just type in something. So if you type in VIX futures, what you'll find is several videos on that. I would suggest everybody watch this one. So if you have time over the weekend, just check out this video. You're going to understand what the VIX futures are, how this expiration cycle works. Today, for our purposes, all we need to know is the SVIX is playing in the M1, M2 range, just like all the other ones that you've probably heard of, just like your UVXY, SVXY, VXX, VIXY, and now these new ones as well. So these are what we call front month VIX futures products. This is an important thing that has come up recently, of course. SVIX is an ETF. It is an exchange-traded fund. The reason that I have to mention this today, of course, as everybody knows, the VXX, the longest-running volatility ETP, it's an ETN, is going through some troubles right now. It's actually trading way above its indicative value. It is completely decoupled. Of course, Barclays, the issuing bank, has suspended share creation. It's causing a lot of problems. So this issue between ETF, ETN is getting a lot of traffic these days. Just know that the SVIX is an ETF, which means it does hold the underlying VIX futures. It does make it safer. Now, under normal functioning, the difference between an ETN and an ETF, basically nothing. Practically speaking, no real difference. But at the extremes, you could definitely make a case that ETFs are far safer. And yes, SVIX is an ETF. So very important to note there. All this creation share nonsense with VXX and all of, who knows when that's going to be solved. I'll probably get a bunch of questions in the Q&A, so stick around for that. I'll give you my impressions on where we are currently at with that whole Barclays mess. But SVIX is an ETF. Next, we should talk about how the fact that there will be listed options. I would assume, obviously that's not a guarantee. When you're talking about products like this, the options market isn't really connected to the issuing banks and the ETN itself or the ETF itself. But with enough volume, I would expect options to be listed fairly quickly. If you wanted me to ballpark it, I don't know. I'm thinking a few weeks for sure, maybe sooner, maybe within a week or so. If we get decent volume, you can expect those options to be trading quite soon. That's personally what I'm more interested in. I'll get into that at the very end. But yes, we're probably going to get listed options. This is an important one. I'm basically just anticipating a whole bunch of questions here because of what happened with the XIV. It was literally accelerated because of a one-day kill shot. And then the TVIX, it wasn't accelerated because of a kill shot, but it was delisted. So what you have to know about these products is they can also terminate, they can also be delisted, and they can also go to zero for the very same mechanism that the old XIV crashed. If there is a spike, a volatility spike large enough that the underlying index that this ETF tracks, that's very important, we'll get into that in a minute, but if that underlying index does see a massive drop intraday, then yes, the SVIX could terminate. There are many ways to think that the SVIX is safer. I will cover all of those shortly, but just know that that can also happen. As far as termination, as far as the issuing, the managers just deciding they don't want to do this anymore, they can also do that. Now, the difference, I suppose, it's a very minor difference, semantics really. With the old prospectus of the XIV, it literally said inside there that if it suffers more than an 80% single day drop, then it can be accelerated. In this case, there's no stated number that they could do that, but they could do it today if they wanted to. This is a fund, and they can simply delist it at any time. They'll probably give warning like they did with the TVIX, right? Remember, we had about a 2-week warning ahead of time. They're going to delist it. But yes, just know, while it is safer, I'll get into all the reasons for that, it can also suffer those one-day kill shots. So be aware of that. I am not a tax expert. I don't give tax advice. The VTS community has members from 68 countries now, I believe, around the world. I can't possibly answer questions even within Canada itself. I can't answer tax questions about all of these other jurisdictions, different account structures. I'm not an accountant. I'm not a tax lawyer. I don't really speak on that. But what I will say is, yes, it does require K1 filing for all the people that are going to be asking. One thing you will want to do, if you don't know how to treat your own taxes, that's completely fine. You're going to hire somebody else to do it. I would definitely mention specifically to them that it is meant to be a 1256 instead of 1099. My difference basically being it is possible that this SVIX, and again, I'm not a tax expert, but it is possible that it is treated as a 60-40 long-term, short-term capital gains type of thing. So you'll definitely want to highlight that for whoever is preparing your taxes. But that's as far as I'm going to go. But yes, it's an ETF. It does require K1 filing. Lastly, this is really the big thing that separates these products from all of the other ones. We'll call the VXX, UVXY, all of those ones, we'll call those the legacy products. These new age products, they are actually they're tracking a different underlying index. And this is very important. They are tracking the short vol index. I'll explain what that means in a minute. Let's just rip through what UVIX is. It's basically identical on the other side other than the leverage factor. So, of course, people are going to associate this one with a replacement product for the TVIX, which was delisted in July 2nd, I believe, 2020. It was delisted along with, I believe, 11 other Credit Suisse products. Really had nothing to do with volatility itself. They basically just wanted to exit their risky products that they deemed. There was 10 or 11 of them, oil and gas stuff, things like that. So the TVIX was gone. You could say this is a replacement for the TVIX because this is a let me just change that on the fly. 2 times long M1, M2 VIX futures product. So again, we're playing in this front end, M1, M2, only difference being based on how these futures are moving around with that constant maturity VIX future. If you don't know what that means, totally cool. Over the weekend, watch that VIX futures video that I prepared. But based on how these are moving around, it's basically going to be tracking 2 times the underlying index that this one tracks. So it is a 2 times long product. We haven't had one of those since the old TVIX. Again, this is an ETF. All the same things I said apply. This is an exchange-traded fund. They will be holding the actual VIX futures within the fund, making it safer. It also should have listed options. I'm actually guessing it's going to be a race here between SVIX and UVIX, but I'm guessing maybe, and I don't know, maybe we'll be surprised by this, but maybe the UVIX might have a slightly more robust options market in the future. We will see. I'm actually very curious to see which one does better. I think both products are going to do just fine. We're going to see. Now, this one is interesting. This is one that oftentimes confuses people, but this is the same slide that I used in the SVIX. Yes, a UVIX product, a long volatility product, can also terminate. They can also just decide that they no longer want to be in the ETF business and they can shut it down. And it can also suffer a one-day kill shot. This is something that a lot of people really don't quite understand. They think, well, it's a long product. Obviously, when volatility spikes, it's going to be doing well. How could it possibly suffer a one-day kill shot? Well, for the very same reason. These things track an underlying index. And just like with the SVIX, if that underlying index moves, say, 80, 90%, certainly 100% in a single day, that's going to cause the fund to go to zero or close to zero, and they would, at that point, decide to probably exit the business. UVIX, this new product, is a 2 times long product. So the kill shot would happen if the underlying index went the other way half as much. So if the underlying index that this one tracks went down by 50%, since it's a 2 times product, that's going to cause a one-day kill shot of the UVIX as well. And that can happen. If you were to imagine, when would that happen? Let's say you had a repeat of an October 1987 type event where you just had a massive market collapse in one day. The next day, if you had a huge vol crush, let's say something happened, it was a terrible day in the markets, but overnight everybody digests the news, and for whatever reason, the market has decided that this is the buying opportunity of a lifetime. Whatever happened the previous day was no big deal, and they just start buying everything like crazy. And there's a massive vol crush on the other side. If that underlying index drops by 50% the next day on a vol crush, well, then there you go. You could get a kill shot. So very, very unlikely. But of course, on a long enough time horizon, given crazy markets, given what could possibly happen, and depending on how you view things, quantum mechanics and all that stuff, quantum physics, what can happen will happen on a long enough time horizon. What can happen has already happened. All of that stuff applies. So just know that those kill shots are possible. And it would be wacky and crazy to see it, but you could have actually had XIV terminate on February 5th and then the old TVIX terminate on February 6th. Wouldn't that have been something to see? But yes, that can actually happen. Again, very unlikely, but just be aware. It's the functioning of the ETF that causes the kill shot, not anything else, and it can happen on both sides of the trade. The UVIX has a K1 tax filing. Don't need to get into that. It's exactly the same. And again, this tracks a different underlying index called long vol. Now, we want to get into what that means because this is really what separates these products from everything else. So the first thing we need to do, and this might be a little boring, I apologize for the people watching, but this stuff is important. If you're going to be trading these products, sit through this for 20 minutes. I promise you, you're going to learn a little something, and you'll be better prepared to make some money in the future. So let's talk about why this is important. First of all, volatility ETPs, as we always say on my live streams, they don't trade based on supply and demand. A lot of people, they're doing their technical analysis. They think if a bunch of people buy or sell these things, it's going to push the prices around. That's not actually how they work. These things trade based on underlying methodologies that are known ahead of time. They are, very clearly explained in all the prospectus. So the VXX, the longest running volatility ETP, trades and tracks based on this underlying index. This is called the SPVIX STR index. It's basically rolling a constant 30-day VIX futures position, and it's tracking that through time. Because remember, the volatility ETPs, all of the front-end products are basically just tracking the VIX futures as they move around. So we can actually also have an underlying index that tracks this, and that's what this is. So what you are looking at here, while it's not called the VXX, this is essentially what the VXX is supposed to be. Now, the VXX is a freely traded ETN. People buy and sell it, and it can decouple from what this line looks like. But what ends up happening, and if you watched all my live streams from last week, you have your education on what authorized participants are. But basically, if the NAV of the VXX goes a little bit too high, then the authorized participants, essentially, they've worked out a deal behind the scenes. They basically have a risk-free arbitrage opportunity where they could short the shares that are created at Barclays, share creation redemptions and all that stuff that we've been talking about recently, and they can push the price back right down to the indicative value, and the VXX will follow this index. If it goes a little bit too low, the authorized participants can come in for their free money, and they can buy a bunch of shares that were created, and they can push the price back up to the indicative value. So the authorized participants actually do their job, not because they're saints, not because they love their job. They do that because it's basically free money, and it actually tracks very well. A lot of people doubt that, but essentially when you look at a chart, we'll get into this, I'm sure, in the Q&A section. This is the VXX NAV minus the VXX IV, indicative value. And you can see it is supposed to flatline. And trust me, it happens very well. These products, 99.9% of the time, they do track very well. So essentially, we say these products do not trade based on supply and demand. They track underlying methodologies. That is very important to understand. Now, you have a little bit of a problem in that, imagine what's happening here. You've got fund managers that are trying to do an end-of-day rebalancing so that the next day they've got all their allocations correct and all of that stuff figured out for the next day. They're trying to mark that to an end-of-day settlement value that hasn't happened yet, right? You have to actually trade during the market, and you have to buy and sell your futures during market hours, marked to a future event, a settlement price for the VIX futures that day that hasn't yet happened. So that's where we introduce something called the trade at settlement, the TAS. Basically, you'll see this said a lot. And what this is I'll try to keep this super basic, but it is essentially a secondary book where institutions can go in during regular trading hours. So I could input a trade. Well, I couldn't do it, but institutions could input a trade right now, intraday. And there's a secondary book that at the end of the day, they will match up those contracts so that the trader is going to get the end of day value when they traded it during market hours. So this is great. If you're somebody managing something like VXX, you have to actually track an underlying methodology of a settlement price in the future that you don't know yet. Now you can use this secondary book, and there's a little bit of a spread at the end of the day, but basically you're going to be assured that whatever you do during that day, your trades are going to be marked to the correct value in the future. So this is awesome for a fund manager perspective that now there's no guesswork. They don't have to try to do anything like get the last possible trade. They can just use this trade at settlement market. The problem is this is going to concentrate a lot of VIX futures purchases to a very, very small window of opportunity there. This is going to be a problem. Now, the VXX launched in January 29th, 2009. So there's a couple other products that launched with it, but 2011 happens. For the first 7 or 8 years, this is not an issue. The volatility space is not large enough to cause a problem, so everything is fine. But you can understand what's starting to happen here. 2011, leveraged products start to come onto the market. You've got your UVXYs. Back then, it was a 2 times product. You've got your SVXY. Back then, it was minus 1 times leverage. Now you're starting to get a bunch of products that are trading in a very, very small window using this system. And it works as far as the functioning of the product. They're able to actually do their job, but it does increase the risk. Fast forward to 2018, the volatility market is fairly large compared to the VIX futures market. And now you've actually got a pretty big problem because leveraged ETPs, they're going to have to be doing their rebalancing now. And all of that is going to be now concentrated in a very small window there. This is going to be a problem. Now, a lot of people think that, okay, no problem. We've got long products. We've got inverse products. Everything's going to cancel each other out. This is going to be fine. The difference, maybe it's small, maybe the longs are a little bit more than the shorts, but it's all going to be okay. Think about what's happening though. If you are a leveraged long product, at the end of the day, you have to go in and buy VIX futures because you have to re-up on all of your futures so that the next day you go into that having the right leverage factor. Right? You've had a good day, the volatility spikes, but you do have to go out and buy VIX futures to rebalance your fund so that it is once again at a 2 times leverage if that's the goal. Well, what about an inverse product? They don't go sell those same futures. What they have to do is they have to go buy those very same futures because they have to cover some of the shorts because they had a really bad day. And now they have to go into the next day, making sure that they've covered all their positions and go into the next day with the right leverage factor. So you've got the long leveraged products and the inverse short products buying the same VIX futures in a very, very small window of opportunity. You've got a $5 billion volatility ETP market that is getting extremely large compared to the relatively small VIX futures market, and you get volpocalypse. So that's, in a nutshell, what happened. It's basically a liquidity crunch in the volatility markets that caused the big volpocalypse event. Enter short vol and long vol. These 2 new indexes, SIBO indexes, they are attacking this a little bit differently. So essentially what they're doing, and I don't want to bore anybody with too much here, but essentially what they're doing is instead of using a settlement value that is basically right at the end of the day, what these 2 indexes are doing is they're taking a 15-minute window, they're dividing it into 5-second increments, and they're using a time-weighted average of all of that, and that's how they're getting their settlement price. So on the one side of it, you've got the M1, M2 VIX futures, 15-minute window, 5-second increments, average pricing for that. That's factored into the end-of-day settlement. The secondary task market, the trade at settlement market, they're also doing the same thing there. They're adding 15 minutes, 5-second increments. They're getting a price there. All of that is crunched into an algorithm at the end of the day, and now they have an end-of-day settlement that is comprised of a much larger window. So this makes it actually quite a bit safer. The concentration problem that essentially is what caused volpocalypse, it wasn't a terribly big volatility spike. I mean, the VIX did go up an insane amount, but the market was down 4%. It should have been able to handle it. I'll actually show you some data in a second there. But it was the end of day rebalancing. These 2 new indexes, the short vol and the long vol, they do largely or even completely, as long as the volatility ETP space remains reasonable size, this does completely eliminate the risk of a volpocalypse event. Now, just note, it does not eliminate the risk of a true, legitimate, organic, single-day volatility kill shot. That can still happen. But as far as talking about the after-day, end-of-day rebalancing issue and a liquidity crunch and all of these products buying the same future and causing mayhem, these new products, these new indexes actually solve that problem pretty well. So the new SVIX uses the short vol, and that's what it's tracking. So it's not tracking this one. This is what the VXX is tracking. And of course, there are others, right? Remember that there are the SPIT for the inverse. There's the SP, the regular one without treasuries. There's the SP5I. There's the midterm one. There's a lot of these underlying indexes. But now you can add short vol and long vol to your bookmarks in your, your daily things that you check, and that's actually going to make the VIX futures market more safe. So we can actually check out some performance. So we've got all the basic indexes here, all of these ones. The one we're really interested in, we'll go straight to it. Let's just use short vol, the SVIX. This is a 1x inverse index. And we're going to compare that to the standard 1x inverse index that all the other products are basically tracking, the SVXY, the old XIV before it terminated, tracking the inverse of the SPVX SP index. I know these tickers are, I mean, it's just so confusing. But yeah, you'll get it. Just bookmark them all. I basically have done that. I can just show you. You just bookmark them all, you know, and once you look at them enough times, you'll understand. But if you dig into this performance, you can see, first of all, the short vol index did substantially better than the original one, even though they're both technically tracking the front 2-month VIX futures. These are identical for both of the indexes, right? This does not change. But the performance itself, essentially how well they track those front 2 months, substantially different here. So obviously you can see the short vol index is way better than the original legacy product ones. Highlighting 2018, for example, the drawdown there, 61 max drawdown compared to 97 for the SPVIX STR. So if you want, I know this is going to make people dizzy, but I kind of have to do it, so apologies here. Let's accelerate down to 2018 real quick. Everybody's head is spinning now. Let's go to February 5th, 2018. The short vol index on that day, down 30.12%. Of course, the long is an inverse. It's up 30.12. Okay, that's fine. That's, you know, it's a terrible day in the market, but that's not a kill shot. That is Volpocalypse with an index that functions really well. Compare that to the normal indexes that the XIV, the SVXY, all of the other ones are tracking, up 96% for the long and down 96% for the short. This is why XIV terminated, because the underlying index that it's tracking is down 96% that day. Now, the VIX futures themselves, it was a rotten day. The VIX was up a lot. The S&P 500 was down a lot. It was a terrible day. And if you were short vol, you would not have had a fun day losing 30% of your money. But it should not have been the 96% kill shot. That only happened because of a massive concentration of VIX futures being purchased in a tiny window of opportunity at the end of the day, and a $5 billion+ volatility ETP market. That is what happens when you are tracking something that is structurally broken. And that's what I would call these indexes. Basically, structurally broken. It's one of those situations, like we keep saying, ETF, ETN. Well, sure, 99% of the time, this is just semantics. Doesn't mean anything. But on the extremes, that's when we really need things to function correctly. And obviously, those products completely broke. So what we are looking at is basically indexes that replace the old broken indexes. Now, I will draw attention to the fact that the other indexes aren't stupid. They're also being managed by people who understand how this works. They have the same data that we have. They're looking at this and saying, well, boy, that wasn't supposed to happen. We never anticipated that happening. So if we actually go down a little bit further and we look at March 2020, for example, the big down day was the 16th of March 2020. You can see the short vol index was down 41.64% that day. An even more rotten day because, of course, aside from the volatility or the liquidity crunch, the pandemic spikes were actually larger than Volpocalypse spikes. They were actually more severe. Volatility spiked a lot worse during this period than it did during February 2018. Down 41, that's a bad day. Up 41 for the long vol index. If we go over, we are now expecting these broken products to have performed terribly. But you can see up 34, down 34, basically down 35. So these ones did a little bit better than the new short vol, long vol. Well, what's happening? Well, the reason this has happened is because they have actually kind of fixed these products as well. Now, not completely. Let me go back to my charts here and I'll stop making you dizzy. essentially what these ones have done, the old legacy indexes that all these SP digit VX numbers that you're getting confused on, what these have essentially done is made a few small changes. And now, in the last couple years, they are functioning just as well as the original index, or these new indexes are, these new age indexes, short vol and long vol. You can see that the short 1 times inverse is tracking really well since basically January 1st, 2020. And this is the long vol product, again, tracking very, very closely to the long vol. So basically kind of fixed. All they really did was, instead of a 1 second rebalancing, they've extended it to 30 seconds. Helps a little bit. The trade at settlement market, instead of being a small bid, a small spread, they've increased that a little bit. So, maybe people are a little bit more willing to do that and use that instead of trying to, get it in at the wire at the last second. They've done a few things like that. They changed the VIX settlement from 4:15 down to 4 o'clock to match the markets, and it has largely fixed the problem. Now, I will say, again, if we're talking about the extremes, it is still worse. The structure of the new ones, although they handled the pandemic extremely well, it is still technically worse. The short vol and the long vol are actually a little bit better. I mean, a 15-minute window beats the other ones, even though we do have proof that the other ones worked. I suspect if we could just get a time machine and go forward in time to a point where the VIX futures or the volatility ETP market is 5 billion again, really, really large, at that point we would start to see these differences show up again. Probably not as bad as Volpocalypse. That was terrible. They've made some adjustments, and it's definitely better now. But I don't want to paint the picture that they are now equivalents. I do still strongly think that the short vol and long vol indexes are substantially better. But good to know for anybody who's worried about these types of things. It is good to know that actually they have made improvements on these things as well. Like I said, they've changed the time. They've increased the spread a little bit. They've increased the window a slight amount. Short vol and long vol are definitely better, but not too bad. So we've got a market that is, not fixed, but we've got 2 new products. Let's see where they fall in this new volatility landscape. So I've got a little mock-up here of our VIX futures term structure, basically this thing. And let's see where all of these products that we currently have, because there used to be like over 25 of these products, and many of them have been delisted, and they either broke because of Volpocalypse, or they just had no interest and the issuing banks just delisted them because they weren't making money. But what we're looking at here, again, the M1, M2 VIX futures products are the original VXX, the VIXY, which is structurally very similar. It's just an ETF. It's tracking a different index. Remember this one. They're basically identical methodology. It's just one of them doesn't have the treasuries included, but basically these are the same products. Then we've got a 1.5 times UVXY, which used to be 2 times until February 27th, 2018. They deleveraged that. And now here we go. We've got this new product. So this is on the long side. We've got a 2 times long UVIX to play with. Right back to the old system when we had that TVIX there. The next thing, of course, we've got the inverse products. Same thing, they're tracking M1, M2, playing at that front end of the VIX futures term structure. SVXY was deleveraged from -1 to -0.5. Again, that happened in February of 2018. And now we've got a new addition, a -1 times SVIX. So in the old days, not too long ago, this would have said TVIX, this would have said XIV, this would not be here, and that would be our volatility landscape. Now, of course, we do have different products that trade the M4 to M7. I've said, 1,000 times, I'm a complete broken record here. I actually really like the M4 to M7 products. I think this part of the VIX futures curve is a little bit better behaved for people who are more of the long-term investor type. So we've got the basically structurally identical, one's an ETF, one's an ETN, but they track very, very similar to one another. The VXE, VIXM, you can check those out. Anytime you're doing your long vol trades, I would just, I can't give any trade recommendations, trade advice, but don't always look to these if you want to go long vol. These have very high beta to the S&P 500. So you are taking a highly leveraged position, especially if you're playing up here in this range. I would definitely give these ones a look. I know the volume is low, but volatility ETPs function differently. The volume is largely based on the underlying VIX futures market, not so much the volume that's being run through the ETF itself. So, I mean, you can always check the level 2 quotes and you can see how deep the market is, but I'd give these a look if I was you. And then lastly, I have to say it because it's my old favorite product. I loved the old ZIV. It was delisted in 2020, same day as the TVIX was gone. What a shame. So I gave a little disclaimer when I first started today that I have never taken advertising money. I've never gotten paid. If somebody out there wants to launch a ZIV replacement, that might be the first one that I actually consider, doing a marketing campaign, doing a series of videos on. I would love to see a ZIV replacement. It doesn't even have to be M4 to M7. Maybe, M2 to M5. Let's split the difference, but let's get something that is a little bit slower moving, a little bit further out on that curve, and spread it out even further. I think that the VIX futures term structure itself was healthier when we had 25 of these products. It was a little bit more predictable. Of course, we can't ever prove that. We can't go back in time and say, here it is with it, here it is without it, because we don't have that. But I strongly suspect that having more products, especially spreading them out along the curve, I think that might actually have the effect of smoothing out the movements of the VIX futures themselves. So again, I can't prove that, but the ZIV, the M4 to M7 futures have not behaved well at all in the last couple of years. And, maybe a small part of that, maybe a medium-sized part of that might actually be because there's no products that are trading out there on that part of the curve or very, very low volume. So I would like to see it. So if anybody out there, if you know anybody, if you just give anybody a little nudge, I would love to see that. Now, if you're looking for a robust options market, again, we are expecting options here on UVIX and SVIX, but for the time being, we really only have the UVXY because remember, the VXX, which is definitely a very robust options market, it is still broken. I mean, the NAV price is now $5.8 above the indicative value. And the VXX is trading, I believe, below 20, isn't, or no, VXX.IV. Yeah, 1938. So, I mean, you're talking about a massive spread there between how it's supposed to be functioning. So right now, currently, I have listed it, but don't trade options on VXX unless you know exactly what Barclays has done and what it means. But eventually, we will probably have a fairly decent, robust options market again when we've got all four of these going. And I do suspect that the options will be quite strong in all of these. The VIXY, the SVXY, they do have options, but just not deep enough to really consider. So I would kind of just skip that. All right, Vol-apocalypse. Here I'm basically just anticipating a wave of questions about, oh, here we go again. The financial industry, they just never learn their lesson. They're coming in with two new products, and we're just going to see an exact repeat of Vol-apocalypse. So essentially, if you don't know, I hinted at it before, but on February 5th, 2018, there was a massive volatility spike. So we saw, let me just minimize some of these windows. We saw the VIX index itself shot up 115.6%, obviously a record. I suspect Black Monday 1987 would have just eclipsed this completely. If we use the old VXO calculation for the S&P 100, we have VIX back to 1990, but using a slightly different methodology, we can go back to 1986, and it actually went up, way further than this. It went up 350% or something like that. It went from 30 to 150, close to close. It went to 172 intraday. So the idea that the VIX has to somehow cap out at 100, that's not true. It can actually go extremely high. So, but it was the record since 1990. Now, on that day, of course, because of massive concentration in the VIX futures market, well, we did have the good old Vol-apocalypse. And we lost the XIV, which was, at the time, sort of along with VXX, that was the pair that when you say the volatility complex, you're really talking about VXX for long and XIV for 1 times inverse short. And we lost that thing. So is the introduction of 2 new products, especially a 2 times long product, Are we just going to do this again? My honest opinion, and again, full disclosures, all of that stuff still applies. In my honest opinion, right now, there's very little risk of something like that repeating. And I'll get into all the reasons for that, because I think it's important to know that. I currently keep a really good eye on when the risk of this elevates, and it's actually pretty low. So the first reason, the current size of the volatility ETP market itself, all of these ETPs combined together, is significantly smaller than it was back in 2017. So certainly in the beginning, there wasn't a whole lot of foresight. Well, we're tracking indexes that are fairly broken. Nobody really knew that until they broke. But yes, right now, we are looking at a market that the relationship between the size of the VIX futures that need to be purchased versus the robustness of the VIX futures itself, we are pretty much okay. We're good to go here. There's very little risk there. The second thing is the SVXY and the UVXY both deleveraged back in 2018. Now, anytime you're deleveraging, of course, that's also going to significantly reduce the number of VIX futures that need to be rebalanced at the end of the day. And these are massive products right now. I mean, these are representing a pretty large chunk of the entire space. And they're half of what they used to be, basically, 2/3 to a half of what they used to be. So that makes it safer as well. Then again, we touched on it, SVIX, UVIX, they're using two new indexes, 15-minute windows, weighted average of the M1, M2 futures plus the trade at settlement market. It's a very, very good way to do this. It would have been nice if people thought about this a little bit sooner, but it is what it is. But that is going to make it safer, spread out the risk even more. And then also, as I touched on, the legacy indexes that we keep calling broken, they're functioning pretty well these days with all those minor changes. Now, again, volatility space is much smaller, so they should function well right now. But even if it grows, I think that they can probably put up a much better fight than they did back on Volpocalypse. And the last thing, of course, is that the whole quote-unquote coiled spring effect isn't really an effect. That was kind of a perfect storm there. If you think back to what was happening in 2017, you remember that going all the way back to 1990, the VIX index itself has only closed below 10 before 2017 only 9 times. That only happened in the early to mid 90s in 1993, happened a few times in the mid aughts, 2006. Other than that, 9 times it closed under 10. I know this is a wall of text, but it's mostly blue, right? I highlighted blue for all the occurrences the VIX closed under 10 in basically that 1 year stretch in 2017 and including January 2018. 54 times it closed below 10. So it was a record-setting historical run of low volatility. And what happens when you get massive low volatility? A little bit of a bump, a little bit of a scare can have an outsized effect. So for all of those reasons, I am saying comfortably right now, and I want to highlight this currently because things can change, but currently, right now, the Volpocalypse threshold, this is a metric that I track, basically the size of the futures in relation to the size of the Vol ETP space, the risk is low. I would say, again, kill shots organically happening because of some type of flash crash or, God forbid, a terrorist attack, those are very real, and those can happen. I am not saying that we are, risk-free. That can't happen anymore. It can. But the actual end-of-day rebalancing broken issue, I think we're pretty clear right now. So, yeah, there we go. Those are the introduction for these new products. I think people will probably be curious. Am I personally going to trade them? Well, I like them. I hate UVIX. I'll just say that at the outright. I think I don't think anybody needs UVIX. I really don't. I think that UVIX is one of those products that it's out there and it's going to get really good volume just like the TVIX did. I have no doubt that the UVIX is going to succeed here, but it's basically an institutional product. There's no real reason why a retail trader would need to get such an extreme beta factor on such a risky product like that. Probably I'll do some type of video in the future as to why does UVIX, or the old TVIX, for example, why does it have the volume that it does? I mean, it's risky. There's no need for it. Why do institutions like it? The reasons might surprise you. They're not the same reasons that retail traders are using the TVIX. And that's essentially my problem with it, is you get the people who know how it works and know how it functions, and they have 20 years experience in the business. They're using it for very specific reasons that don't really have much to do with the actual movement of the UVIX or the TVIX. So for me personally, I'm not going to use that. If it has a robust options market, great. I like to represent things with options anyway. So even if I really like these products, and I think the SVIX is fine, I really do. I used to use the XIV. So this is even better. So yeah, I would use this. But I'm an options trader. I've been options trading since 2005. I think that there's a better way to structure the trade. And the only reason I would actually use these is if I had to. Like if I had a strategy that really fit well with these. I currently don't. Options are just better. Now, a lot of people go out in the options market and they use it to gain leverage and to take on risky positions and try to make a bunch of money. That's not what options trading is about. Options trading is a risk management tool. That's how it should be viewed. There are ways to structure trades much more specific to your hypothesis rather than just ETFs, right? Very binary, long, short. Obviously, you can hedge and you can do a few things, but it's quite binary. I think options are the key. I'm glad these products have launched, and I really hope that the options market launches soon, ramps up in volume, spreads are decent, everything's trading normally, like I hinted at, though, too. Remember, it's basically based on underlying markets. So the better this does, the more robust the options will likely be, sort of a self-fulfilling prophecy. It rolls over on each other. So we do want to see these products being used, but I personally might not use them specifically if that answers your question. I'll probably just wait for the options to launch, and there's tons that we can do there. So I'm looking forward to that, introducing some cool trades and some strategies, and yeah, it's all good stuff. More products, the better. Even if we don't use them, it's still better. It's going to make a volatility space that is a shell of its former self. It's actually going to give us more options. It's going to give more liquidity. And I think it's actually going to make those futures behave a little bit better. So don't be completely surprised if the M1, M2 futures, again, we have no real way to prove this because you can't go back in time and go head to head on things that don't exist. But I suspect the futures themselves might spend a little bit more time in a normal contangoed situation the more products that we have. Looking forward to seeing that play out. I hope it does. So hopefully that answers a few of your questions. I understand that was a little bit, maybe you don't need to know all of that stuff. But again, if you're going to be trading these products, you definitely do. So do yourself a favor, read the prospectus as well. Just take a weekend, take a couple hours, skim through it if you have to, but get that done. And then we can all make some money. So yeah, let's answer some questions. For anybody new to my live streams, I'd like to think most of the time they're a little bit more fun than this. So definitely come back in the future. A lot of times we do trades and, live trading and whatnot. But getting through technical details of ETFs is, it's kind of a snooze fest. Sorry about that. Let's get back to this question that this person's been in my head. Do you think women have it easier than men? Let me try not to cancel myself. Well, just in general, I think that obviously different challenges for different people, right? Everybody has challenges. I don't know if they're exactly equal, but they're pretty close. I think that's my answer. That's my politically correct answer, that while the challenges that we face are different than the challenges women face, I am not going to be that person that says, boy, it's harder to be one or the other. Life is hard, and we're all doing the best we can. I know there's a Will Smith joke in there somewhere. Let's get into this. Can we get an update on your views of VXX, since it was announced recently that they lost $450 million over issuing securities beyond registered amounts? So yeah, that was kind of an interesting thing. Essentially, they registered a certain level of shares to be created across their spectrum of products, and they breached it. I don't know how an oversight like that could happen. I understand the initial oversight. I don't understand why you just keep going and you just bowl right through it. I don't know how they managed to do that. But yeah, it's going to cost them a lot of money. And it also means that this situation, again, you can always check this yourself. This is the VXX, so the actual trading value, the NAV value of the VXX, minus the VXX.IV. Because remember, as we pointed out, the VXX is actually supposed to be tracking this. And 99.9% of the time it does, because of those authorized participants and the share creations and the deal they have worked out. It actually tracks extremely well. This broken situation might actually be extended because of that news that you are mentioning in your question, because of the fact that I don't know how long it takes to re-register and pay out all the problems that it caused and then finally keep going. The only thing that I will say is that the announcement itself said nothing specifically about VXX. A lot of people read that and said, oh, there it is. They're going to fix this right away. Yes, I would imagine they are going to try to fix this across their entire spectrum of products, but that doesn't give us any indication of when they're going to get around to resuming share creations on VXX. So if you have trades open, nothing has changed. If you're on the long side and you've got options going and you're playing this market, this basically decoupling of the NAV to the IV, if you're long, it's the same game as before. You want to try to see if you can get in there with some type of defined risk option spread and make a little bit of money as this thing further decouples. But it is a race against the clock, because as soon as they resume share creations, this thing is going to very quickly go back to the indicative value and you're going to lose. So if you're on the short side, what you essentially wanted to do, and I highlighted that in our trade that we went over, this is the trade. This is what it looks like. It's basically flat since we opened it. We did a whole live stream on this specific trade. I highlighted 6 possibilities, and then I chose this one and traded it live. Here is the NAV value above 25. The indicative is all the way down here. So the short trader, this is a short vol trade. I'm hoping that they announce this before April 22nd, because then I'm going to get that big gap down and I'm going to have a nice trade on my hands. It's a race against the clock on both sides, but I don't think the announcement recently changed a whole lot with this situation. We are still in the dark as to when this is going to launch. And there is even an argument to be made that they might not even want to do the VXX. That announcement said they're going to resume their broad spectrum of products. It did not say that they are specifically going to resume the VXX. I still tend to think the VXX is successful enough that they will want to fix it and keep going. But it's not as successful as people think it is. They think, wow, this is $1 billion product. It's just, they're probably just raking in the money. There are many angles to that where they're not actually making nearly as much as you think they are. So I said it on Twitter recently. I'm kind of 80-20, maybe 90-10, but 80-20, whether they will even continue with this stupid VXX. It's got issues. It's kind of a pain. It adds risk to their book. It doesn't make a whole lot of money. I don't know. I suspect they'll resume, but boy, hopefully before April 22nd, because I have money on the line. Not much money, and I always do defined risk options, but yeah. Commented on that, got about it. How do you feel about replacing the VTS leveraged ETF choices with futures? I don't. Logistically, we just couldn't do that. If you can do it on your own, if you understand how to do that, great. There's nothing wrong with replicating ETF positions like, say, the QLD, the 2 times NASDAQ. You could certainly do that. You could go into the VIX futures market, or not the VIX futures, the futures market for specifically the ETF. You could do that. You could do the SPY. You could replicate these things. You could do it with options, no problem. But as I mentioned before, we've got a community of people from 68 countries, a lot of people, different account structures, IRAs, tax sheltered, non-tax sheltered, different jurisdictions. No. Futures require a whole nother level of education that I wouldn't do. But feel free, if you are a very sophisticated trader, to go for it. If you want to email me, I don't talk about futures much because basically, got to be a chef that eats my own cooking. And everything that I present at VTS is literally 100% of my own capital. I'm just sharing my own portfolio. 100% every trade that you see in the email, that is the trade that I took. You can go into my account, you will see the exact same trade. So you will never see futures in my account doing that. What is with these questions? Are women more volatile than men? Next. No, we'll have an open Q&A in the future. We did one of those when I was in Panama, opened a bottle of wine, and we did a 2-hour live stream, people asking questions about, men, women, relationships, religion, politics. I didn't get in trouble. I made it 2 hours, drinking, and didn't say anything terribly stupid. So maybe we'll do that again in the future. That'll be fun. Question. I like when people say question. Stands out a little bit. So in the future, do a Q or do a question, and I'll see it right away. How do I best understand volatility when it comes to equity options? My focus is on technology equities. I can't really help you very much with the education. I don't follow other people. I don't read any books. I just kind of, let me get this going again. Oh, it didn't. Let's just forget about that. Yeah, I'm not the right person to ask about, hey, where should I learn this specific thing? Standard answers, you could just search out a bunch of books that are specific to what you want to learn. You could go on Twitter and you could follow a bunch of people that tend to talk about these things. They're all, YouTube is great for that because it is actually a search engine. Twitter is not a search engine, but yeah, I don't know. When it comes to equity options, this is extremely self-serving. Apologies, but we do have a VTS options service that, it's been going for ages. It was temporarily put on hold, but I will get that up and running again in a few months. I had to make a few changes to sort of clean up a little bit of the troubleshooting questions that were coming my way. It was a very large community with a lot of people in the options community, and I was just overloaded with questions. So I have to do some type of course or some type of 20 video series or something, clean up a few of those questions. But check back in a few months and we will have our option service up and running again. And then again, extremely self-serving for me to say that, but yeah, maybe you can learn from me. Yes, they do require K1. We went over that. You probably asked that before I started. So SVIX and UVIX cannot become decoupled. Sure, they could. There's always way. These are managed products, so sure, they have functioning and methodologies that track underlying indexes. They're better, and the ETF structure itself is better, obviously, for many reasons. But yeah, I can't say definitively that something similar couldn't happen again. I suppose it wouldn't happen in the same way. But it's the same thing with TVIX happening in 2012. They also did the same thing, but for different reasons. There's always something new on the horizon. So I never say, oh, this can't happen. It probably won't. I'm confident that it will track very well. I like the way they function, and I like the methodology they've gone with here. I can't definitively say they won't break. Is the end-of-day settlement procedures also make this instrument more stable? Yes. Again, a lot of these questions were probably asked before my presentation. Yes, definitely the 15-minute window using both the TAS market and the VIX futures market, a combination of the two there, it's definitely going to make those SVIX, UVIX products more secure. Okay. Can we open the same options for VXXY if we're too late to the trade, or would you recommend waiting until you create a new options trade? So what you're alluding to is this trade that I have open, that if anybody's interested in seeing, I don't do anything, half-assed when I'm making videos or live streams. So if you want to see that trade, there's actually a full video here for the trade. So you can watch this one, live short VXX options trade. I went through my whole rationale for opening that trade. So you can always watch that full thing. But essentially your question is, is it still available? Can you still do it? Because this was, a few days ago. The price hasn't changed. It's actually up a little bit of money. So my trade is up $70. So it's basically flat from where I opened it. So technically, yes, essentially, like I said, here's the NAV value. The indicative value is all the way down here. So it's just waiting on Barclays to do their job and get this thing back, and we're going to get a nice gap down. And then it's just a matter of whether the VXX itself is going to decay a little bit further in the next couple of weeks. That would be nice to get into the max profit range. But you could do this. Now, the question that you're going to have to ask yourself is what expiration? Because this is a vertical spread. I like verticals in this situation because you're not buying into a big Vega headwind. You are buying a long contract and a short contract, pretty tight distance between the strike gap. So you've largely eliminated the Vega factor for this trade, and it is a more directional delta trade in this case. So there's nothing saying that you couldn't extend this a little bit. If you were worried that Barclays might drag their feet a little bit, I did 22nd of April. It was before that recent announcement. If I was going to do the same trade again, yeah, I might look to the 6th of May, maybe even the 20th of May. You could push it out to this trade here. You're not going to get quite the good ratio, but it's still a nice trade. And now you've got more time. So this is the 20th of May. You've got the price right here, NAV value or the indicative value here. You can see the win-loss ratio is slightly worse, of course, because as you go further out in time, it's more likely that it's going to happen. Option participants know that. Remember, it's an efficient market. It's not quite as good as the trade I did, but you're going to get more time. So you're going to have to decide whether getting a couple of extra weeks, getting an extra month, probably a good call at this point. I'm still reasonably confident they'll get this done before the 22nd. That's 3 weeks from now. They should, but don't trade based on that. I have a hunch that it's going to take a couple weeks. I would imagine I'm gonna take a wild guess that means absolutely nothing to anybody, but I'm going to guess on Wednesday, April 13th. They're going to resume share creation. There you go. But yes, if you want to do the same trade, the options premiums have not changed, and consider pushing it out a little bit. Get yourself a little bit more time there. Okay. Congrats. Great presentation. Thank you. Thank you very much. Super boring stuff, but I think it's important and people need to know this thing. So I'll take one for the team and I'll bore people on my live stream. So, come back next week. We'll do something more fun. I think we can do better as educators to explain the risk of these leveraged products in vol. I know many people that lost a lot of money on that in the past. Yeah, no question. I get a lot of emails. I've made it very clear that people can ask me questions over the years, and I have heard crazy sob stories about people losing way too much money, people, risking losing their net worth, their marriage falls apart, they're worried about losing their kids. It got bad, and it can get bad if people trade, like you said, if people are uneducated about these products. These are not simple, and there are people out there. The one that I always shout out, and I will absolutely do it again, if you're not following Bill Luby on Twitter and not reading his blog, you're doing yourself a little bit of a disservice there. So I will just go ahead, and I've done this 100 times. I don't really, promote people, but he's one of the good ones. You absolutely have to follow at VIX and more. And there are people in the space educating on these things. He's one of them. Obviously, Vance Harwood is one of them. You want to go on Twitter and you want to follow people who are a little bit less of the, hey, check me out, I made 500% return on this random option trade. Follow less of those people and follow a little bit more of the Bill Lubys and the Vance Harwoods. And the education is out there, but I suppose it's the same problem I encountered today. This is boring stuff. I mean, who's interested in that? So I think if I made the exact same thing and the video was, here's how I'm going to double my account in 6 months using the new SVIX and UVIX, I'd have twice as many people watching right now. But let's do the education, because these are super complicated and you can get into a lot of trouble. Like I said before, the beta factor to these, to the S&P 500, in many cases, the UVIX is going to be at 5 times. 5 times long, 5 times short the S&P 500, essentially. It's not exactly tracking, but long-term, it's an inverse beta to the S&P. Would people short, if there was a 5 times inverse S&P 500 product, would people buy it? I mean, you'd have to be insane. Making a profit shorting the S&P at 1 times, using the SH, 1 times inverse S&P 500, that's a tough trade to make money on. 5 times the S&P 500? I mean, it's just insane. People don't even know what they're buying when they're using these products. So that's why I say, I mean, who in their right mind is going to actually use the UVIX? Institutions will. There's lots of tax harvesting ways that it's good. There's, I'll make a video on it, but they can buy a bunch of shares. They can short it out, all the risks. So they're basically net neutral, and then they can loan their shares out and make 7% on the fees there. There's lots of ways that institutions will be encouraged and wanting to trade these. I can't think of any reason why a retail trader would want to use them. But yeah. Do you think that UVIX will have more decay factor than UVXY and VXX? By mathematical definition, yes. The UVIX is a 2 times product. UVXY is since February 27, 2018, it's 1.5 times, and the VXX is just a 1 times. So because the VIX futures market's in contango 84% of the time, long term, we can expect these products to all of them decay. The ones that you named there, all 3 of those are expected, minus a few wild and crazy spikes along the way. Those products are going to decay long term. Come back 10 years from now, all of them are going to be down from where they are now, probably miles down. And yes, you can just see it in order. The 2 times product is going to have not only the VIX futures themselves headwind, but also the volatility drag. When you're doing a leveraged product and you're re-upping every single day, there is a little bit of a drawdown there every single day that you're, not every day because it can work both ways. But again, the VIX futures are almost always in contango 84% of the time. You're going to have volatility drag that's way larger than the UVXY, and that being larger than the VXX. Yeah, you named them in order for which one's going to go down the fastest. Next live stream, or in an upcoming live stream, I will do the full volatility landscape, and I will show the long-term decay factors of all of these. And what the expectation is over the next 10 years, how much they go down in a day, a week, a month. I will show everybody that, the updated results. But yes, you can expect the UVIX to be a terribly fast decaying product long term, with spectacular gains for a few weeks here and there when there is a really crazy market. Don't know. The aggressive vol strategies, it was removed from the portfolio because I want to have enough time to rework it for the current volatility landscape. It's since 2018, the volatility regime change that we've talked about so much. It's a real thing. Volatility market is different now than it was before 2018. Not all strategies work in all markets, and I had to put that one on hold for a little while. I'm going to give it a serious look. I'm going to fix it up so it matches more closely with how things are trading these days. And when that happens, the decision whether to use SVXY at a 0.5 or the new SVIX at -1, we will see. We will see. Again, I prefer options, so I might not use any of them, but I don't know. See which one matches the strategy better. Problem with SVIX, I'll go into a little bit more here. The problem with a -1 times inverse now in this market is that the trends are fewer and farther between. So from 2011 to 2017, there were volatility spikes that hurt, those single days where you don't see it coming. You wake up the next day, the futures are all red, and you get gut kicked, right? If you're short vol. That happened throughout that whole period. But the offset was that there were a lot of trends where the short vol trade would work for several weeks or even a month or two in a row. These days, we're getting larger volatility spikes and more frequent. I think I showed recently that something like 85% of all the largest volatility spikes happened within the last 3 years. So the last 4 years. So you're getting more spikes, more frequent. And then on the other side, you're not getting paid because the trends are shorter as well. They're getting cut short as well. So the risk reward ratio of being in the 1x inverse short vol trade is no longer as attractive as it used to be. That's why my portfolio, the VTS portfolio, we have shifted largely to the 2x leveraged equities indexes. So, I mean, this strategy uses the QLD, 2x NASDAQ. This one, gold, bonds, but it also has a 2x Dow Jones. When the markets are calm, we can go ahead and get aggressive there. And this one, the leveraged strategic tail risk, this whole position used to be a short vol position, and now it's not. The SSO, the 2x S&P 500, is more efficient than the SVXY. It's more efficient than the SVIX. It's just a better trade. 2x leveraged equities has less spike risk than vol products do these days. That was not the case pre-2018, but these days. And the trends make just as much money. So it doesn't no longer make sense to use these products, right? You're taking on too much risk and you're not getting enough trend on the other side of it. So you have probably noticed that a lot of volatility strategies that at one point in time were successful and doing well, a lot of them have dropped off, and some of them very, very significantly. There are some that are just absolute disasters in the last 2 months, but 2 years, 3 years. We're in a different volatility regime. Got to be very, very careful with short vol these days. It's just not a slam dunk. It never was, but it's certainly not now. Okay, what will happen to VXX price if they decide to delist it? If they do, then this is important to know that if they do delist the VXX, which I doubt they will, but I am not going to say I know for sure that they won't. If we look at the difference between the NAV and the IV price, what they're going to do if they delist it, unfortunately for anybody who's holding this thing, they are going to mark it to the indicative value. That's how these things are settled. So anybody who thinks, oh, that's fine, I'm going to be bought out at this really nice elevated price, you're not. You're going to get the rug pull, and it's going to go all the way down to the indicative value. So surely if you're short, you can't hold it short these days, so it doesn't matter. But shorts are going to be happy, longs are going to be upset. You're going to lose all of that value. And that's exactly what happened with TVIX in 2012. It decoupled from the indicative value by about 90%. And when they fixed it, rug pull, $300 million just taken off the board. And anybody who was holding it thinking, wow, I'm holding this awesome product, they're going to buy me out at this great price. Nope. They're going to buy you out at that very low indicative value where it is supposed to be trading and tracking. So that's the truth. Yeah, be aware of that. I don't want to give you the impression that I think they're going to delist, but they could. Do you have any forecasting metrics such as GARCH, or do you use strictly your own volatility metrics? Yeah, I do everything based on the metrics that you've seen in my emails. I do. I'm always experimenting. I'm always doing other work. It's just that because VTS, my service, is exactly my portfolio, at the end of the day, I only do what works best for me, right? You might see the vast majority of the financial industry, I maintain, and I obviously have no way to prove this. This is just an unfounded accusation, but I think it's probably true. A lot of fund managers, they're not in the same trades that their clients are. I mean, I find it highly unlikely that the standard pie chart, buy and hold 6 different asset classes and hope for the best type of investing philosophy, I find it very unlikely that these Wall Street experienced traders have their own capital in that same portfolio. So it gives them leeway to talk about things that sound cool and, let's talk about gamma exposure and let's have a gamma dashboard and all this stuff that sells and attracts attention on Twitter. And they have the freedom and the luxury to do that because their trades are not in the same trades that they're marketing to the public. Some of them obviously are. I'm not making a wide sweeping accusation, but a lot of financial advisors are not going to be holding the same pie chart from their bank, getting their fees there. It's just not going to be like that. So for me, at the end of the day, I only share, I only trade, I only send emails with things that are literally my capital. So a lot of the things that go outside of the volatility metrics, I investigate it, I go down the rabbit hole, and almost always come out the other side thinking, that doesn't do any better, or it's actually significantly worse. So no one even knows about UVIX yet. It's only 160,000 volume. It was, I don't know. I'm not going to say that. I think it was a pretty decent start. So let's check UVIX really quick. 181,000 shares of UVIX has gone through. And I believe SVIX is even more. 230,000. You know what? I'm going to call it a success. For day one, I'm going to call that a success. I think that 230,000 of SVIX going through. Both of them launched at 15, so good comparison. Yeah, pretty good. Pretty good for that the group that launched that. Mark my words, Barclay will make their VXX announcement at market close of Friday, April 15th. Okay, 2 days later than I did, but that's still inside the wire. I'm still going to make my money if that's the case. So I hope you're right. I hope I'm right. I hope we're both right. April 22nd is my cutoff. I had an actual trade open as well for the May. I closed that out. It spiked up. We had that real shakeout there, and then it dropped back down. And there was a lot of weird action around this time. And my trade, it's options, it's lower volume, wider bid ask. I just had an opportunity to close something out that should not have been profitable, but it was. And so I only have one trade open. I only have April 22nd. So I hope you are right, my friend. Oh, okay. Interesting. I went on that whole rant and I was actually talking about the wrong thing. Timothy was actually asking about taking the vol trend UVXY trade. Okay, that changes things. The VXX trade, sure, that's still available. The vol trend, I'd skip that. I'm very likely going to open one tomorrow, but this one, I mean, obviously this trade has technically worked very well because remember what we're doing here is the UVXY was way over here when I opened it. So I'm basically using a short vol strategy with a broken wing butterfly, hoping that it expires somewhere in this range. Here's the price now. If it happens to go this way further, I mean, this trade would lose money, but I'm 2 times leveraged Dow, 2 times leveraged NASDAQ, and 2 times leveraged the SPY right now. So surely I would make 10 times more money if this trade goes very badly. That's going to be very good for my portfolio. That's what diversification means. You need things that are actually counter trend to the bulk of your portfolio. So this trade is designed so that it profits when volatility goes down, just not so fast that it goes out of the range. Knowing that if it does go out of the range, kind of who cares? I don't want to say that. I don't want to lose money on this trade, but you can see it's actually down $1,100. It's significantly worse now. So if you opened this trade now, you'd get a better premium. You could do that if you wanted. But I probably am going to open a new trade either tomorrow or Friday. I'm not going to close this one, but I'm going to open another layer. Remember, we have availability of 2 of these, and we're actually only in layer 1 right now. So I will probably throw on another 1% allocation. I would say you're probably best to just stick to that one and just let this one go. Options trading is fairly time sensitive. You don't want to try to catch up on old trades. It's not the same trade today that it was a week ago when I opened it. So I'd skip that. What's the difference UVX TVIX? I assume that was asked before my long, boring snooze fest of a presentation. Yeah, I probably answered all of that already. Actually, I'm not sure that's correct. Timothy, UVXY tracks VX, V1, TVIX tracks. No, that is incorrect. Sorry. Yeah, they both track the exact same futures. So it's both M1, M2 futures. The UVXY is a 1.5 times leverage factor product tracking the index called the SPVXSP index. definitely don't need to know those ticker symbols, but that's what it's tracking. The UVIX, the new UVIX, is a 2 times leveraged product, and it is tracking the, where's your original question? I don't know how many, I'm just going through, missing these. It is tracking the long vol index. So it's a different underlying index. And then to get back to this one, yeah, that'll do it. But I went through the whole presentation. It was too boring the first time. It's going to be even worse the second time. How do you deal with weekend holidays when calculating VX30? How do you know which day the future expires every time? Well, it's actually pretty easy to deal with that because they don't count. So let me just show you my volatility barometer calculations here. I mean, you use the dates, right? So if there's a holiday, where is it, 21 to 25, you can see there's no 26, 27 because it's not a trading day. So when you're talking about the VIX futures here, and when they're rolling these percentages out, this cycle, because there's a lot of days in this cycle, they're rolling 4% a day, but those are trading days. So we can just calculate how much of each these products are holding. You can even go to the actual website of the product. Like you can go to the, is this link still going to work? That's an old, yeah, that's an old link. You can go to these products though, and it'll actually tell you what their current weighting is of the products. So I haven't updated those. I never look at it because I track it myself in my own spreadsheet. But yeah, it's because trading days only. So you just skip them, just leave them out and calculate how many days to expiration. Remember to exclude holidays. So Good Friday, for example, next month, make sure that April 15th is not included because that's a holiday. Don't just do 5 days a week. Sometimes there's 4. And yeah, pretty easy stuff. Oh boy. Oh boy. What's going on here? You mad at me or are you mad at somebody else? Okay, so I'm going to assume you're not upset with me. You're allowed to get upset with me. I don't block. I don't delete comments. You want to insult me, go ahead. Don't insult other people. We have rules here. So before I try to clean all this up, let me just remind everybody of the rules of engagement on my streams. You can say whatever you want to me. I have thick skin. You can call me a fraud. You can say whatever you want. I'm never going to block you. I'm never going to do anything. Don't swear because the YouTube algorithm hates that. So don't swear at me. Say it in a high level English way of insulting me. That's fine. But don't insult other people. Don't swear and don't post third-party links. That's going to get your comments deleted. So what is going on here? If you don't know for sure, keep your mouth shut. That's not going to flag the YouTube algorithm. Not cool. I don't know who you're talking to, but that's fine. You can speak that way if you like. It's confusing for people for no reason. If you don't know, just keep it shut. Yeah, you're allowed to go through life speaking to people that way. That's fine. Not sure it's going to get you very far, but okay, so what's going on here? Actually, I'm not sure that's correct. I think Brent made a typo in his title. I know I didn't make any mistakes. Could have made a... Yeah, there's 3 people arguing back and forth in the comments. You guys go do your thing. Again, I mean, obviously be civil. There's no reason to. But speak however you speak. You are a free individual. Do you know how Barclays will determine which VXX holders have the right of... I do not. Sorry. I've had no experience managing ETFs, no regulatory experience, never worked in any compliance departments. I don't know what they're doing back there with all of this. I don't know what order it goes in and, no idea. It's a bad situation. I know that. And all I'm really concerned about is how quickly they can just fix this and move on. But I'm sorry, I don't have any... I probably know as much or less than you do about this. I didn't really dive into it too much. Don't really care. Just fix the stupid VXX and let's move on. What are the different indicators between the defensive rotation, tactical balance, and strategic tail risk? That's a good question. It's kind of specific to VTS. I typically don't answer questions on public live streams that specific, but most people have left by now. So the strategic tail risk, 100% uses the volatility barometer. Literally direct values If it's 55 or less, we're in the 2 times S&P. If it's up to 80, we're going to be in the IYR real estate ETF. And above 80, we're going to be in long vol with the M4 to M7 product, which I actually highlighted as something that I really like, the VIXM. So this is our long volatility product of choice within the strategic tail risk strategy. Now, the other two are not using the volatility barometer directly. The tactical balanced is using, I can't tell you exactly, of course, but more weighting on the cash VIX term structure and more weighting on the cash VIX oscillator. And then the defensive rotation is more weighting on the actual VIX futures market. So you're talking about the VX30 to VIX roll yield. It's using a large combination as well, but with an extra focus on the VIX futures market. So those are two different markets. Remember, the VIX and the VIX futures are entirely different. The cash VIX indexes, the VIX 90, VIX, VIX 3M, 6M, they are derived based on S&P 500 options market. The tactical balance strategy is geared a little bit towards looking for signals from the cash VIX term structure. Defensive rotation is using the VIX futures and getting more influence from there. So there is crossover, but they are two different strategies. All three of those are different strategies with different safety positions. That's what diversification is. I've calculated all the beta factors and all the ways that these products typically move around. Of course, it can break down sometimes and you take additional losses, but they're all different, getting signals from different places. Yeah. What is the WEIX? Also a new vol product. Yeah. I've got a new series that I eventually will get around to doing where I'm going to do a dedicated video on each of the products. And these more dynamic type products that have either some additional hedging going on, I'll also include those. So you're talking about your, oh, I did one already, MV. God, I can't even remember. It's not doing well at all. What was that one called? Go to my YouTube channel and go on Volatility ETP. I don't know, maybe that'll come up. Termination. Oh boy. It's somewhere, MVPX or something. I can't even remember. But yeah, the one that you're mentioning there, it's just another dynamic product. I'll probably do a presentation on that eventually as well. The dynamic products themselves, we've never really seen any of them really work that well. So I don't know. I don't have a whole lot of confidence that they can structure something better than we can on our end. If you understand options and how that works and structuring trades, I think you're better off just using the basic options and then structuring what you want from there. I think a packaged dynamic product, they tend to be quite a letdown. Prospectus sounds great. You hear a description, oh, we're going to do this, we're going to hedge it all out, and it's going to be, we're going to outperform this and that. And that, yeah, in practice, they tend to fall very flat. So, but if you want, I will do that. Is your cat doing better now? Yeah, look at her. She is doing better. The last time we spoke on this, she was very sick, in and out of the hospitals. We did CAT scans and CT scans, and we paid an insane amount, like $1,600 or something for an MRI for a cat. Taiwan's medical system is insanely good. So for me, MRIs are free, basically, and you do them literally same day. They just tell you, go ahead and go upstairs and get an MRI. It's crazy. As a Canadian, that's insane. Our medical system is as slow as you could ever imagine. So Taiwan's awesome, but for cats, it was insane. We got the MRI, the results came back. Turns out she ruptured a disc in her spine. So full rupture of the disc. I mean, it popped out, and yeah, that's what was bothering her. So she had an issue where she was shaking, and she wasn't eating, she wasn't acting like herself. Thankfully, it wasn't a stroke or something like that, some type of aneurysm. She fractured or she ruptured a disc. So she'll be fine. She's jumping around today. Cats are tough. She'll be fine. So business partner's back, doing her job. I mistyped on my futures question earlier. I was just asking about using futures in my portfolio. Yeah, go for it. You're obviously quite sophisticated if that's your question. So I would assume you can handle that and you know what you're doing. I cannot possibly do it for a community of, what we have. WIX volume is only 1,000. Okay. Well, I'll put it on the list. I'm not overly interested in it, but yeah, I'll check it out. All right. I'll check it out right now. Who cares? Finance, WIX. Because, obviously, I'll show you what I mean. I haven't even really looked at this, but I can probably take a guess what's happening. This is a product that has a futures. I believe, I haven't looked at this in a little bit, but something like a potential for a 20% VIX options hedging mechanism that jumps in. And of course, when you read the profile, it's going to sound like it's amazing. Oh, that's exactly what I want. I want the S&P 500 performance, but I want to reduce the drawdowns, right? That's what these products typically say in their presentations. Well, let's see. Are you following through on that? Doesn't seem like it, right? It's supposed to be S&P 500 performance. I don't know. You be the judge. It's, like I said, you can probably do a whole lot better just understanding options trading and structuring your own trades. So, okay. Yeah, thank you very much for that. She's the best. And I think that's it. I think today was like I said, if you're a regular, today was boring. Well, I'll try to think of something that might be a little bit more fun for next week. And but thanks everybody for coming. And good luck if you're going to be trading these products. Good luck. They are safe as far as the structure goes. Then you just want to layer in, okay, does it represent my opinion on the market? Does it fit into my trading strategies? There's nothing broken with them. They're structurally sound. The new methodology is definitely an improvement. But at the end of the day, like I said, do you really need UVIX in your life at all? Do you really need a beta of what it's going to be, 4.7 or something to the S&P? We